Hey everyone, and welcome back for another deep dive. Today we're looking at monthly dividend stocks.
Yeah, monthly dividends instead of quarterly.
Exactly. It's all about making that money work harder for you.
Absolutely.
So our deep dive is inspired by this article I was reading called Looking for Passive Income. These 3 high-yield dividend stocks cut you a check monthly.
Okay, interesting.
And, one of the things that just blew me away was this stat that said, over a 50-year period, dividend-paying stocks historically outperformed non-dividend payers.
Oh, wow.
We're talking 9.17% annual return
fantastic.
versus 4.27%. So that's a pretty big difference.
Yeah, that's significant.
So let's jump into the first company that they talk about in this article, and that is Agree Realty, or ADC.
Okay, so Agree Realty is a REIT, which is a real estate investment trust, and they focus on standalone retail properties.
So like those strip malls and stuff?
Kind of, but more like those standalone buildings you see dotting the landscape.
Okay, so are they betting on brick and mortar retail? Like in the age of online shopping, is that even a smart move?
Well, that's where it gets really interesting, because their strategy is all about those essential businesses that are basically recession-proof.
Recession-proof. What do you mean?
Businesses that people need no matter what's happening in the economy. Think grocery stores, home improvement, things like that.
Okay, so they're not going anywhere.
Exactly. And get this, they have a 99.6% occupancy rate.
Wow.
Yeah. And their average lease term is 7.9 years.
That is pretty impressive. So, give me some names here. What kind of tenants are we talking about?
Well, think about those familiar names you see everywhere you go. Walmart, Tractor Supply, Dollar General, Best Buy, CVS.
Oh, okay, yeah, I see those all the time.
Exactly. And these are companies with really solid track records financially. So they're very likely to keep paying that rent.
Which keeps those dividends flowing.
Exactly.
Okay, but what about spreading the risk? It kind of sounds like they're putting all their eggs in one basket, even if it is an essential business basket.
That's where their diversification strategy comes in. No single tenant accounts for more than 6.1% of their annual rent.
Okay, so they're not betting the farm on any one company.
Nope, they're spreading it out pretty strategically.
That makes sense. It's all about managing that risk.
Absolutely.
Are they still growing? Are they acquiring new properties and things like that?
Absolutely. They're not sitting still. The article mentioned a recent $524.9 million investment in 144 new properties.
Wow. So they're definitely expanding.
They are. And what I find really reassuring is that they have a very strong balance sheet and low leverage compared to other REITs in this space.
So they're not overextending themselves?
Exactly. They're being financially responsible, which is always a good sign.
All right, so let's get to the nitty-gritty here. What kind of dividend yield are we talking about?
They're offering a 4.1% yield right now.
Okay, not bad.
And their payout ratio, the percentage of their profits they pay out as dividends, is a very reasonable 73% of their adjusted funds from operations or FFO.
Hold on, what's FFO?
Oh, good question. So FFO is basically a REIT's version of earnings. It's kind of like a more accurate picture of their actual cash flow, which is super important when you're evaluating, dividend sustainability.
Okay, so they're actually generating enough cash to cover those dividend payouts.
Exactly.
And that 73% payout ratio means they've got some wiggle room even if things get a little tough in the economy.
Exactly.
All right, so let's move on to the next company, Realty Income.
All right, Realty Income.
What really stood out to me is this 53-year track record of generating consistent cash flow.
Yeah, they've been around for a while and have really proven themselves.
And, they own over 15,450 properties.
It's a massive portfolio spread across the U.S., the U.K., and Spain.
Wow, that's incredible. So give me some examples, what kind of businesses are renting from them?
Well, think Dollar General, 7-Eleven, Walgreens, FedEx, and CVS.
Oh, wow. So it's a lot of familiar names again.
Exactly. Those businesses that are woven into our daily lives.
Yeah, I can definitely see why they've been able to generate such consistent cash flow for over 5 decades. They're tapping into those everyday needs.
Exactly. And one thing that's really interesting about Realty Income is their use of triple net leases.
Triple net leases, what's that?
So with a triple net lease, the tenant actually pays for that property taxes, insurance, and maintenance costs.
Oh, so those expenses are shifted away from Realty Income?
Exactly.
So less overhead for them, more predictable cash flow, which means hopefully more stable dividends.
Exactly. That's one of the reasons why they've been able to maintain that really impressive dividend track record.
Okay, I get it. But what about this whole shift to online shopping? Isn't that a big risk for a company so focused on retail?
You're right to bring that up.
Mm-hmm.
But Realty Income has been very strategic about mitigating that risk Remember those tenants we mentioned? They're all businesses that offer essential goods and services.
Right. Those things that people need no matter what.
Exactly. Even with the rise of e-commerce, people still need to buy groceries, pick up prescriptions, send packages.
Okay, so they're betting on those needs that aren't going away anytime soon.
Precisely.
Okay, so let's break down their tenant mix a little bit because I'm curious to see how it all shakes out.
So grocery stores represent about 10.2% of their annual rent.
Okay.
Convenience stores are at 9.4%, and then you've got dollar stores coming in at 6.6%.
Okay. And what about their biggest tenant?
Their biggest tenant is Dollar General, and they only account for 3.4% of their annual rent.
Okay, so they're really spread out. They're not relying too heavily on any one client.
Exactly. It's all about diversification.
I like it. So what about their dividend yield?
Realty Income is currently offering a 5.5% dividend yield.
Okay, that's pretty attractive.
And they've been increasing their dividends for decades. They're actually a dividend aristocrat.
Oh, what?
A dividend aristocrat. It means they've increased their dividend payouts for at least 25 consecutive years.
Oh, wow. So they're not just paying dividends, they're consistently increasing them.
Exactly.
All right, well, let's move on to the third company, Stag Industrial.
Okay, Stag Industrial is a little bit different. They're a major player in the U.S. industrial property market, specifically warehouses and distribution centers.
Oh, interesting. So they're kind of on the other side of that e-commerce boom.
Exactly. As more and more people shop online, the need for these massive warehousing and distribution spaces is only going to grow.
Right. It's like the backbone of the whole e-commerce ecosystem.
Exactly.
But how big is this sector, really? Is this a sustainable bet for the long term?
Well, according to Grandview Research, the global warehousing and distribution market is expected to grow at a compound annual rate of 8% through 2030.
Wow, 8% compounded annually. That's huge.
It is, and Stag Industrial is really well positioned to ride that wave. They've gone from owning 93 properties at their IPO in 2011 to a whopping 573 properties today.
That's impressive. So they're definitely not afraid to expand and go after those growth opportunities.
Nope, they're all in.
All right, so who are some of their big-name tenants?
Their top tenant is actually Amazon.
Amazon. Wow, okay, that's a pretty big endorsement.
It is. And they also have other well-known tenants like Soho Studio, Eastern Metal Supply, American Tire Distributors, and Tempur Sealy International.
Okay, so they're not just relying on Amazon. They've got a pretty diverse mix of tenants.
Exactly. And their financials are solid, too.
Yeah.
Their payout ratio is a reasonable 60% of their FFO.
So those dividends are well supported by their earnings.
That's right.
And what's their current dividend yield?
Right now, it's sitting at a solid 3.9%.
Okay, so not as high as Realty Income, but still a pretty respectable number.
Exactly, especially when you consider their growth potential and that focus on the booming e-commerce sector.
Okay, so we've got three very different companies here. Agreed, Realty, Realty Income, and Stag Industrial. Each one kind of approaching this monthly dividend thing from a slightly different angle.
That's right. And what's fascinating is that they're all REITs, but they're tapping into very different parts of the economy.
And that's a great illustration of diversification, right? It's not about putting all your eggs in one basket. It's about spreading out your risk across different industries.
Absolutely. And that's a key takeaway for anyone considering adding monthly dividend stocks to their portfolio.
Okay, so diversification is key. But we also need to talk about risk management, right? Like, what are some of the potential downsides here? What could go wrong?
Well, one of the biggest risks with REITs, especially those focused on retail, is this constantly evolving retail landscape.
Right, like we were talking about earlier, the whole e-commerce thing. Even though Realty and Realty Income are focused on essential businesses, there's always a chance that consumer behavior could shift in unpredictable ways.
Exactly. And we've seen this happen many times in the past.
So even those businesses that seem immune to those shifts could be affected at some point.
It's definitely a possibility.
Okay, so what about interest rates? Like, how do those affect REITs?
That's a great question. So REITs often use debt to finance their property acquisitions. And when interest rates go up, their borrowing costs increase.
Which eats into their profits.
Exactly. And that can impact their ability to maintain those dividend payouts.
So it's not just about looking at the dividend yield. You really have to understand a company's debt levels and their overall financial health.
You got it. And another risk to consider is the potential for oversupply in certain sectors.
Oversupply, what do you mean?
Well, if too many developers rush into a particular sector, like building a ton of warehouses or distribution centers, it can lead to an oversupply of properties.
Which drives down rental rates.
Exactly. And that can put pressure on those REITs' profits.
So it's like any other market. Too much supply, not enough demand, prices start to fall.
Exactly. And in the case of REITs, that could translate into lower dividend payouts.
So it's all about being selective and really understanding the long-term trends in those different sectors.
Absolutely.
Okay, so we've talked about the risks associated with those changing consumer habits, the impact of interest rates, and the possibility of oversupply. Anything else we should be aware of?
Well, there's always the general economic climate to consider.
Right, like if the economy goes into a recession, that's going to affect pretty much everyone.
Exactly. REITs are not immune to those broader economic forces.
So even with a well-diversified portfolio, you're still exposed to those macroeconomic risks.
That's right.
Okay, so it sounds like even though we're focusing on monthly dividend stocks, which tend to be a bit more stable, we still need to be aware of those bigger picture market dynamics.
Absolutely.
Okay, so to wrap up this part of our deep dive, it seems like monthly dividend stocks can be a really valuable addition to a portfolio, but it's important to go in with your eyes wide open.
I completely agree. You need to understand the risks, do your research, and choose companies that align with your own investment goals and risk tolerance.
All right, well, let's take a quick break, and when we come back, we'll dive deeper into these triple net leases and explore some other nuances of dividend investing.
Sounds good.
So we were talking about these three companies, Agree Realty, Realty Income, and Stag Industrial. And it's interesting how they each represent a kind of a different approach to this whole monthly dividend thing.
Yeah, they're all REITs, but they're playing in different sandboxes, so to speak.
Right. And I think that's a good reminder that even within a specific asset class like REITs, there's still a lot of room for diversification.
Absolutely. And that's a key principle of investing in general. Don't put all your eggs in one basket.
Exactly. Now, before we go any further, we need to address the elephant in the room when it comes to REITs, especially those focused on retail.
The ever-changing world of consumer behavior.
Exactly. Like with online shopping on the rise, are brick and mortar stores really a safe bet for the long haul?
That's a question a lot of investors are asking these days, and it's something that both Realty and Realty Income have clearly considered in their strategies.
Right, like they're laser focused on those essential businesses,
Yeah.
the ones that offer goods and services that people need no matter what's happening with the economy or shopping trends.
Precisely. Things like groceries, prescriptions, those everyday necessities that aren't going away anytime soon.
It's about identifying those companies that are not just surviving, but thriving in this new landscape.
Exactly. And when you look at their tenant lists, you see a lot of names that are really adapting and evolving with the times.
Okay, but what about Stag Industrial? They're not directly exposed to those consumer spending habits in the same way, are they?
That's right. Stag Industrial is playing a different game altogether. Their focus is on industrial properties, specifically warehouses and distribution centers.
So they're benefiting from that surge in online shopping.
Exactly. As more people buy stuff online, the demand for those facilities is only going to increase.
And we talked about that stat earlier. The projected growth of the warehousing and distribution market is something like 8% compounded annually through 2030.
It's a huge market with a lot of tailwinds.
Okay, so let's connect all this back to our listeners. What does this mean for someone who's thinking about adding monthly dividend stocks to their portfolio?
I think the key takeaway here is the power of diversification. Even if you're only investing in dividend-paying stocks, you still want to spread your risk across different sectors and different types of companies.
So don't put all your eggs in the REIT basket, even if those REITs are focusing on different things.
Exactly. You want to create a well-rounded portfolio that can weather those inevitable market ups and downs.
Okay, so diversification is crucial. But we also need to talk about those triple net leases. They seem to play a pretty big role in the success of these REITs.
They do. And it's a concept that a lot of people might not be familiar with.
So can you break it down for us? What exactly does a triple net lease involve?
Sure. So with a triple net lease, the tenant is responsible for paying the property taxes, the insurance, and the maintenance costs.
So basically the REIT just collects the rent and the tenant takes care of everything else.
Pretty much. And that creates a very predictable income stream for the REIT because they don't have to worry about those fluctuating expenses.
And it can also be beneficial for the tenant because they often get a lower base rent in exchange for taking on those responsibilities.
Exactly. So it can be a win-win situation for both parties.
Okay, that makes a lot of sense. So it's not as simple as just buying shares in a REIT and collecting those dividends every month. There's a lot more to it than that.
You're right. It's important to understand the underlying business model and how those triple net leases contribute to the REIT's overall profitability.
Okay, so we've talked about diversification and those triple net leases, but let's talk about some of the potential risks associated with these monthly dividend stocks. Every investment has its downsides, right?
Of course. And it's important to acknowledge those risks before making any investment decisions.
So let's get real here. what could go wrong?
Well, one of the biggest risks, as we touched on earlier, is that whole evolution of the retail landscape.
Right, like even those essential businesses that Agree Realty and Realty Income are focused on could be disrupted by unforeseen changes in technology or consumer behavior.
Exactly. And then there's interest rate risk.
Right, because REITs often use debt to finance those property purchases, and when interest rates rise, their borrowing costs increase.
And that can put a squeeze on their profits, which could ultimately impact their ability to maintain those dividend payouts.
So it's not just about chasing those high dividend yields. You also need to look at a company's debt levels and their overall financial health.
Exactly. And another risk to consider is the potential for oversupply in certain sectors.
Like if too many developers start building warehouses in a specific market.
Precisely. That could lead to lower rental rates and put pressure on those REITs' profits.
So it's all about understanding those long-term trends and identifying the companies that are strategically positioned to capitalize on those trends.
They got it.
Okay, so we've talked about those evolving consumer trends, interest rates, and the possibility of oversupply. Anything else investors should be thinking about?
Well, there's always the general economic climate to consider REITs. Like most businesses are sensitive to economic downturns.
So if the economy slows down, people might cut back on spending, businesses might struggle, and that could trickle down to those REITs' rental income and dividend payouts.
Exactly. It's a reminder that diversification is important, but it's not a foolproof shield against those broader macroeconomic risks.
Okay, so it seems like even though we're focusing on monthly dividend stocks, which tend to be a bit more stable than some other investments, we still need to be aware of those big picture market dynamics.
Absolutely. No investment is completely risk-free.
All right, so to sum up this part of our discussion, it sounds like monthly dividend stocks can be a great way to generate passive income, but it's crucial to do your research, understand the risks, and choose companies that align with your own individual investment goals.
I completely agree. It's all about making informed decisions and building a portfolio that you're comfortable with.
Okay, well, let's shift gears a bit and talk about how investors can actually reinvest those dividends to accelerate their wealth building journey.
That's a great topic. Compounding is one of the most powerful forces in investing, and we need to talk about how to harness that power through dividend reinvestment.
All right, so let's dive into that. What are some of the ways investors can reinvest those monthly dividends?
One popular option is to use a dividend reinvestment plan, or DRIP.
A DRP. What's that?
Basically, it's a program offered by most brokerage accounts that automatically reinvests your dividends back into the same stock.
Oh, so you don't have to do anything. It just happens automatically.
Exactly. It's a great way to put your money to work for you without having to constantly monitor your investments or manually reinvest those dividends yourself.
That sounds super convenient, especially for someone who's new to investing or just doesn't have a lot of time to actively manage their portfolio.
Precisely. And it's a particularly effective strategy with monthly dividend payers because those dividends are being reinvested more frequently, which can accelerate that compounding effect.
So it's like getting a little boost to your investments every single month.
Exactly. But it's important to note that DRIPs aren't for everyone.
Why not? They seem like a pretty sweet deal.
They can be, but there are a few things to consider. For example, if you're looking to diversify your portfolio beyond a single stock or a specific sector, a DRP might not be the best fit.
Right, because you're constantly reinvesting those dividends back into the same stock, which could lead to an overconcentration in that particular holding.
Exactly. And that could increase your overall portfolio risk.
Okay, so what are some other ways to reinvest those dividends if a DRIP isn't the right strategy?
Well, you could manually reinvest those dividends into other stocks or funds. That gives you more control over your portfolio allocation and allows you to diversify your holdings more effectively.
So it really depends on your individual investment goals and risk tolerance.
Precisely. It's all about finding the approach that works best for you.
Okay, so we've talked about DRIPs and manual reinvestment. But before we wrap up this part of our deep dive, I want to go back to something we mentioned earlier, finding those monthly dividend stocks in the first place.
Right, like where do you even start?
Exactly. There are so many companies out there. How do you narrow it down?
Well, there are a few resources you can use to start your research.
Like what?
One option is to use financial websites like Yahoo Finance, Google Finance, or Morningstar.
Those are the big ones, right?
They are. And they all have screening tools that allow you to filter for stocks that pay monthly dividends.
So you can basically set your criteria like dividend yield, payout ratio, sector, market cap, and those websites will spit out a list of companies that meet your specifications.
Exactly. And they also provide a ton of information about each company so you can do your due diligence and really understand their financials, their management team, and their overall business strategy.
So it's a good starting point for your research?
Absolutely. But remember, those screening tools are just that, a starting point. You don't
Okay.
want to rely solely on those filters to make your investment decisions.
Right. You still need to do your homework and really dig into those companies.
Exactly.
Okay, so we've got those financial websites with their screening tools. What else?
There are also some dedicated dividend-focused websites out there that can be really helpful.
Oh, like what?
Websites like dividend.com and, sure, Dividend. They offer in-depth analyses of dividend-paying stocks, including those that pay monthly.
So it's like getting expert insights and curated recommendations.
Precisely. They often have lists of companies that meet specific criteria, like those with a long history of dividend growth, or those that are undervalued by the market.
Okay, so that can save you a lot of time and effort.
Exactly. But remember, it's still important to do your own research and not rely solely on those recommendations.
Right. It's all about taking ownership of your investment decisions.
Absolutely.
Okay, so we've got those financial websites, the dividend-focused websites, and of course we can't forget about good old-fashioned research.
You're right. Reading company annual reports, industry publications, and financial news can give you a much deeper understanding of the companies you're considering.
It's about connecting those dots and seeing how those individual companies fit into the bigger picture.
Exactly.
Okay, so this has been a really insightful conversation about reinvesting those dividends and finding monthly dividend stocks. But before we move on, I want to emphasize something that we touched on earlier. The importance of understanding your own risk tolerance and investing goals. It's not just about chasing those high dividend yields or blindly following recommendations.
You're absolutely right. Every investor is different, and what works for one person might not work for another.
Exactly. So it's crucial to do your research, understand your own financial situation, and make investment decisions that align with your individual goals and risk tolerance.
Well said.
All right, well, let's shift gears one last time and talk about some broader themes in dividend investing. Like, what are some of the key things investors should keep in mind when building a long-term dividend portfolio?
That's a great question. And I think it's the perfect way to wrap up our deep dive into the world of monthly dividend stocks.
It's amazing how these companies we've talked about, Agree Realty, Realty Income, and Stag Industrial, they really showcase the diversity of the REIT world.
Absolutely. Each one's tapping into a different segment of the market.
You've got Agree Realty with its focus on essential retail, Realty Income with its massive portfolio of properties leased to those stable businesses, and then Stag Industrial riding that wave of e-commerce growth.
And what's interesting is that they're all capitalizing on trends that show no signs of slowing down.
Exactly. People will always need essential goods and services. Online shopping is only going to become more popular, and as e-commerce grows, so does the need for those warehouses and distribution centers.
It's like they've found their niche and positioned themselves for long-term success.
So as we wrap up our deep dive into monthly dividend stocks, what's the one key takeaway you want our listeners to remember?
I'd say it's the incredible power of compounding.
Compounding. That's where the magic happens, right?
Absolutely. When you reinvest those monthly dividends, you're essentially putting your money to work for you, generating more and more income over time.
It's like a snowball rolling downhill, gathering more and more snow as it goes.
Exactly. And that's why monthly dividends can be such a powerful tool for building wealth, especially for those who are in it for the long haul.
It's not just about the immediate income, it's about leveraging the power of compounding to create lasting wealth.
Precisely. And that's what makes dividend investing so appealing to so many people.
It's a strategy that can help you achieve your financial goals, whether it's early retirement, financial independence, or just having a little extra cushion in your life.
And the beauty of monthly dividends is that you see those returns more frequently, which can be really motivating and encouraging.
It's like getting a little pat on the back every month, a reminder that your investments are working hard for you.
Exactly. And that can help you stay focused and committed to your long-term financial goals.
But it's important to remember that dividend investing isn't a get-rich-quick scheme.
Absolutely not. It requires patience, discipline, and a willingness to ride out those inevitable market fluctuations.
It's a marathon, not a sprint.
Well said. And like any marathon, it's important to pace yourself, stay hydrated, and keep your eye on the finish line.
Okay, so for our listeners who are eager to explore this strategy further, what advice would you give them?
I'd say start by defining your goals. What are you hoping to achieve through dividend investing?
Are you looking for income growth or a combination of both?
Exactly. Once you know what you're aiming for, you can start researching companies that align with those objectives.
And don't forget to consider those broader economic trends we discussed. Are those companies well positioned to navigate the changing market landscape?
Absolutely. Investing is a dynamic process, And it's important to stay informed and adapt your strategy as needed.
And remember, it's okay to start small. You don't need a huge amount of capital to get started with dividend investing.
Exactly. Even a small initial investment, consistently nurtured over time, can grow into something substantial.
It's like planting a seed and watching it grow into a mighty oak tree.
I love that analogy. It really captures the essence of long-term dividend investing. It's about patience, consistency, and a belief in the power of compounding to create lasting wealth.
Well said. And on that note, we'd like to thank you for joining us on this deep dive into the world of monthly dividend stocks.
It's been a pleasure sharing these insights with you.
And remember, the journey of investing is all about continuous learning, exploring new opportunities, and making informed decisions that align with your financial goals.
So keep those dividends flowing and happy investing.
Thanks for tuning in.